Hello traders, in today's video I want to talk to you about the 3 worst times to trade and the best times to trade. Now everybody wants to know where to buy and sell a particular market. I get that. But the truth is trading is as much about knowing when not to trade as it is knowing when and where to enter a particular position. That might sound like the same thing at first, but I assure you it isn't. For example, let's just take an example. Let's say the Euro USD has formed a beautiful reverse bearish pin bar at a key resistance area, but it occurs right before the ECB rate decision. So it isn't the right time to trade, even though the location of the signal was spot on, but the timing was off. Now, before I scare you off with yet another factor that you need to consider, let me tell you that it isn't all that difficult. In this video, I'm going to share 3 times when sitting on the sideline may be, and quite often is, the wisest choice to make, as well as which are my favorite days to trade over the trading week. I'll also share some questions to ask yourself to make sure that your mental game is on point. So keep on watching to learn the best and worst times to trade the global financial markets. Number 1, immediately before or after high impact news. Now, as traders, volatility is what makes us money. You can't profit from a market that never moves. We've all been in one of those positions that takes off almost immediately in our favor and doesn't want to stop. After 2 days of traveling, let's say 300 pips, we're left with a boatload of cash. Those are the good weeks, but they can also be incredibly dangerous, especially for the novice trader. You witness how an increase in volatility can produce profits almost like it's out of thin air. On the surface, it all seems quite innocent. After all, what's wrong with observing that higher volatility equals greater profits? Well, nothing at all. But now you can see where I'm actually going with this. You know that news, particularly high impact news like rate decisions, non-farm payrolls, they trigger very volatile conditions. If you've ever attempted trading events like these, then you'll know just how dangerous that it can be. Yes, volatility can make us money, and it does make us money, but attempting to trade in an event that has a random outcome outside of your control and market's response isn't always going to go the way that you think it's going to go. It also goes against what we do here as price action traders. Our trading edge comes from trading high probability signals that the markets generate for us on the higher time frames, namely the daily time frame. There's no edge in trading the news, full stop. That goes for entering a position immediately before or after an event. Even if the market behaves and moves in your favor, you'll more than likely be stopped out before you can realize any profit. So, having said all that, what's the solution? Very simple. You wait for the session to close at the end of the New York session before making any further consideration. That's it. I call this the settlement time, and it occurs each and every trading day between 4 p.m. and 5 p.m. New York time. And if you're trading the 4-hourly time frame, wait for the next 4-hour candle to close before even thinking of committing any of your capital to any one trade. The simple act of waiting for the next daily or 4-hourly candle to close has kept me out of more dangerous situations than I can actually remember, than I can count. Notice I said simple and not easy. There is nothing complicated about waiting for a candle to close. Nothing at all. There's nothing for you to do except wait. Now, anybody can understand that concept. The difficult part is having the patience and discipline, 2 traits that you must have if you wish to be successful, to wait and do nothing. Know that just because the market is moving, it does not mean that you have to trade it, that you have to be involved in it. The little known truth is that about 99% of volatility you see every single day is just a trap waiting for the unsuspecting trader. Quality setups do not come around that often, but when they do, you must be ready. And when they are present, then you enter with full conviction and full confidence. If you're chasing volatility every day, you won't be ready. Number 2, the first and last day of the week. The first 24 hours of the new trading week is usually relatively slow. In fact, all of the market participants are just getting back online after their 48-hour break. It's also when the markets are figuring out which direction that they should head over the coming week. Now, with this in mind, I tend to stay on the sideline each Monday unless I already have an established position from the previous week. And of course, I do not have a problem holding my established positions over the weekend. On the other hand, on the other end of the spectrum, we have Fridays. The final 24 hours of a trading week is often marked by lower liquidity. As you may well know, a technical analysis works better in highly liquid markets. Moreover, I don't like taking on new risk on a Friday just before the weekend. The Forex market can sometimes gap. I'm sure you've witnessed a gap quite aggressively at the week's open, and I don't want to get caught on the wrong side of the Monday gap. So for me, between those 2 days, Friday is the worst offender in my opinion. The idea of opening a new position in front of a 48-hour break or a 48-hour window where I'm helpless to do anything but watch, it doesn't sit well with me at all. And again, this is from previous experience. So there you have it. Monday and Fridays are the 2 worst days to trade in my view, with the latter, Friday, being even worse than the Monday. By the process of elimination, you can see that I like to open new positions between Tuesday and Thursday. I have found that the best setups occur over these 3 trading days. By this time, the market participants have settled in for the week. We have some directional bias of the market. It's also far enough in the weekend to cut your losses if the market happens to move against you. To wrap up, here's how I approach this. Any quality setup that occurs between Tuesday and Thursday is fair game. I will sometimes trade on the Monday, but the setup has to be absolute top notch, absolute top of the tree. It needs to be so good that I'd have to be crazy to pass it up. Fridays are off limits in my book. You're better off waiting until Monday to reassess the situation, to get a handle on the track of the market over that week, at the beginning of that week. That way, you don't need to worry about the market gapping against your position at the start of a new trading week. Number 3, when you aren't in the right state of mind. Now, we've all been rattled when it comes to trading. I'm sure you'd agree with me. Trading is a game of mental discipline. Anyone can learn the technical aspects. Those who can keep their emotions under control, they come out ahead. They are the winners. Now, we know what happens to those who can't. But no matter how disciplined and controlled that you become, there will always be those days. I'm sure you know the ones that I'm referring to here. Maybe you're not feeling very well, or didn't get a good night's sleep, maybe not thinking clearly. It could be that you're too busy with other tasks which deserve your attention, means your thoughts are elsewhere through the day. Another dangerous scenario would be if you're on a losing streak. If you have lost 3 or 4 trades in a row, chances are your emotions are on high alert. Whatever the case, if you're not feeling up to the task of trading, then don't. The markets aren't going anywhere. They'll be there for you the next day, the next week, the next year, for the rest of your life. There's no rule that says you must trade on any particular day. Even if there is an A-grade setup sitting in front of you, time away from the charts may not be a bad idea. In fact, I think it's usually a great idea. It helps you immensely if you're not feeling up to the task to just not have time in front of your charts at all. And if you are experiencing a losing streak, then one of the best things you can do is take a break. Close your laptop down or your computer. Don't worry about it. Take some time off and come back, maybe risking only half your normal position size, until your confidence returns. So in summing up, guys, knowing when to trade and when not to trade, in my view, is critical as a trader. It's not something that you hear most people talk about. It will help you keep your capital safe when conditions are volatile or markets are illiquid, and capitalize when the time is right. That's what we do as traders. One of the worst times for placing trades is immediately before or after high impact news. These events range from central bank rate decisions to non-farm payrolls and on and on. By waiting for these sessions to close at 5 p.m. New York time, you avoid the chop that often occurs around these events. I would estimate that around 9% of the setups I take occur on the daily time frame. The rest happen on the 4-hourly chart. Any other time to avoid is the first, as I said, and last day of the week, Friday being the worst offender of the two. Taking on a risk ahead of the weekend is a very, very risky endeavor, and I do not encourage it. As for Mondays, markets can be indecisive as traders recover from the weekend lull. Trading is a mental game, and I would argue that it's probably 80% mindset and 20% mechanical, 20% technical. So if you aren't feeling at the top of your game, take a seat on the sideline. It's better to miss a setup or two than risk a costly emotional meltdown, which is only going to cost you money. I have found, just to repeat, Tuesday through Thursday are the best days to trade, in my view, and in over my 11 years in trading experience. Just remember, do not enter a position immediately before or after high impact news. And finally, make sure your mental game is on point before you risk any of your hard-earned trading capital. So guys, I hope you've enjoyed this little video training on the best times to trade and what to avoid around trading times. Once again, this is all born out of my experience, not theory. Words don't teach, experience does. I'm sure you'd agree with me there, and I hope you have found this somewhat meaningful. Until next time, talk to you soon. Bye for now.